Hi, this is James Eng of Old Capital, and today we're going to be talking about multifamily financing and sort of an economic update, July 2022, and just getting back from Tennessee in the Smoky Mountains, and we saw a lot of bears out there, and it seems like we can't get away from bears these days when we're looking at economic news. Here is sort of the economic, you know Dow Jones, S&P, NASDAQ, sort of year to date, how they've done in terms of returns, and it's all but red. So anywhere from 10 to 15, 20% down. So people are feeling a little bit lighter in their wallet when they look at their 401k balances or, when they open up their quarterly statements, it's a little bit lighter on the stock market. And so, why is the stock market down? A couple of reasons. We'll, start with inflation. Inflation came in at 8-9% right now. So historically, it's been about 2 or 3%. And just the last 6-12 months, it's really getting up to almost 10% now. And so it's just getting more expensive to do anything, more expensive for food, for gas, for pretty much any input into any of these categories. And so the Fed is in charge of keeping this inflation down to 2 or 3%. And they've taken that very seriously. So the Fed looks at inflation, but they also look at unemployment. So unemployment has been around that 3% in the past, and then with every recession, it gives up maybe 2 or 3%. The financial crisis got it up to about 10%, but right now we're still sitting at about 3.5%. So pretty strong unemployment. The big issue is inflation. We're starting to see a little bit of the initial claims go up. So just watch that number as that's sort of a leading indicator for the unemployment rate. So here's what is driving a lot of the heartburn right now in the market is the SOFR forward curve. And so at the beginning of the year, it's close to 25 basis points or zero. And then with every hike, this thing keeps going up. And with inflation being at 8-9%, the Fed, this is their weapon of choice to stomp it out. And this is really beating down on demand. And so you're seeing it go from probably about 225, 2.5, and then potentially getting up to about 3.5% by the end of the year. And then most people are seeing this as sort of the top, and the Fed having to come down off of that. And if we're in recession, sort of beginning of 2023, bringing that down back to about 2.5%. And so that's the front end of the curve. That's what's driving it. And so a lot of people are looking at the yield curve, which is basically starts at about the 1 month treasury all the way up to the 30-year treasury. And most of the time you want to see, for you to tie up your money, you're thinking, all right, I've got to be paid more in an interest rate in order to, get my money tied up for 10 years. I want to get paid more. And so you usually see this as a diagonal upward curve. But right now you can see that the 2-year treasury, let's say, for example, is at 3%, and the 10-year is underneath that, like 2.7, 2.8%. And so you're seeing the 10-year minus the 2-year dip underneath zero, which is sort of a leading sort of recession indicator historically for the last probably 3, 4, 5 recessions. When that goes negative, it's usually only a matter of time before you see the next recession. So you've got the SOFR curve predicting a recession. You've got the inverted yield curve predicting a recession. And then unemployment is probably the last thing that has not given yet. So we're still pretty much at full employment at 3.6%. But these other items are leading to a recession. So that's why we started with the bear going up the mountain at the beginning. So a lot of people are pretty negative right now. 10-year treasury has stayed sort of within range. 275 to about 325 is where it's been trading, I would say, the last 2 to 3 months. And so we saw a little bit of spike up at 3.5, which was pretty scary for most people. But staying in this range is pretty consistent with what we've seen. And having that stabilized helps the Fannie Mae, Freddie Mac rates a lot. So went through a little bit economic update, but let's get into sort of the multifamily update and then the financing market right now. So my background, born and raised in Houston, went to school at UT, and then have been up here in Dallas since 2006, underwriting properties as a loan underwriter till 2015 with GE Capital. And then also since 2015, really been originating multifamily loans and investing in properties all throughout Texas since 2015. So here's the market update. I was trying to figure out, what to talk about for this month, and I just went through my emails, and this is what I'm seeing in my emails, right? So this is coming from listing brokers. This is coming from investors. Price improvement from when it originally went out, all right, back on the market. Okay, so the deal was out. Now that guy fell off, or the deal fell through, the financing fell through, equity fell through. Now we're bringing it back on the market. Pricing reduced, dropping the whisper price. And then on the bottom here, these are investors saying, look, we're raising equity right now. We went back to the seller. We're under contract already right now, and we're getting pricing reductions, right? So $1 million off here, $2 or $3 million off here. So we're seeing reset pricing right now. So I would say most deals is probably anywhere from 5 to 10% of reset pricing right now. But the challenge right now is we're going to talk about the financing, but on the equity side, a lot of people, they not only invest in real estate, but they also invest in stocks. And so they're feeling nervous about sort of their positions, and they feel a little bit less rich when you're down 15, 20% on the equity side. And so a lot of deals that would have filled up in, 2, 3, 4 days, they're taking 2, 3, 4 weeks to fill up. And so we're seeing multiple emails, multiple reach outs, people. You're actually having to call investors. You can't just like do a webinar or send an email. You're having to call investors, follow up, go through their questions. And then a lot of people were seeing, all right, I've got to raise $20 million, but my LPs, my usual, $50,000, $100,000 check guys, they only want to put in half of it. And so how am I going to close this deal? And so we're seeing a lot more people go with a little bit of preferred equity, where that's sort of one check writer into the deal, and you're going to provide them probably a little bit more, a higher return in order to make sure your deal gets closed. So seeing reset pricing right now, and then we're also seeing that equity is more difficult. So that's sort of in the last month, that's what we're seeing in terms of the market right now. So why are people still buying multi? The vacancy is still very low. So rent growth, the lease trade outs are still great. Your leases are going to be able to reset. So if inflation keeps running at 5, 10%, you're going to be able to reset your leases every 6 to 12 months. And the pricing resets allowing, on the single family side, this interest rate increases are also working against single family, right? So single family, you were at 3.5%. Now you're at 5.5%. And so that's driving a lot of people out of single family and the affordability. And so it's actually cheaper to rent in a lot of markets right now. And then you're buying at reset pricing. So you're probably 5 to 10% down from where you were in, the first quarter. You'll be able to buy at a higher cap rate than the interest rate. And then the bonus depreciation also is 100% this year. So in terms of your capital stack, this is what a lot of people are seeing right now in terms of options, right? So you've got, your floating rate bridge is still there, but you're probably SOFR plus 450. So your all-in rate's about 6 to 8%. There's still fixed rate bridge out there. This might be recourse bridge. This might be non-recourse bridge if it's over 15, 20 million. It's about 5 to 575. And then Fannie and Freddie is creeping up closer to 55, 60% with 475 to 525 rates. So interest rate cap pricing. This has been a huge thing for floating rate borrowers. Just the cost of this continues to go up as these, SOFR federal funds and the SOFR keep going up. This is what it's predicted to do. And so just the cost of these things, the insurance provider is going to have to pay out this amount of money. This is a $20 million loan at a 2% strike, and SOFR is already above 2%, right? So they're having to pay out day one on this. And so this is about 2.5%, 3% of your loan amount in cost on your interest rate cap. So bake that into your projections on if you do get a floating rate loan. All right, so here's the loan options right now. We'll go through them, but recourse bank loan, Freddie SBL, Freddie conventional Fannie Mae, and then non-recourse bridge. So a lot of recourse bank loans right now, they're anywhere from $1 million all the way up to 15 million. And you don't need an interest rate cap. There's no cash flow sweep. They can close in about 30 to 45 days. We're seeing rates tick up. So we were able to get some deals sort of mid fours, but probably now you're probably low fives to mid fives, just depending on the size of the deal. But you're able to get, IO for 1 to 2 years, and then you probably go 20, 25 year AM on most deals. But this is quicker approval, more flexible loan docs, and then your prepay is significantly lower. So it might be like a 210. But you are signing personally. So they do want strong balance sheets. They do want strong, secondary sources of income. So this was the loan we closed out in Tyler. The guarantor was a medical professional, and they had a good sort of secondary source of income. And we were able to get them a recourse bank loan, close in about 45 days, 5-year term fixed. It was about 4.5, 18 months IO, and then no prepay. So that was a deal that, could have probably gone Fannie Freddie at maybe 60, 65%. And then we were able to get a little bit more leverage with the recourse bank lender, probably closer to 75 on that one. So Fannie and Freddie right now, they're definitely still quoting a lot of deals. A lot of people like that. They are quick. They could do an early rate lock. 10-year treasuries down right now, so you're sizing better. So we're doing a lot of refis right now, and then even new debt, new acquisitions. We're seeing a little bit more Fannie and Freddie, because if bridge lenders are at 65 to 70 and you have to buy an interest rate cap, it might be time to go back to Fannie and Freddie at 55, 60% leverage. We're seeing full term IO on a lot of deals. If you are more experienced, they're able to maybe quote a little bit lower debt service, maybe a higher amortization for your sizing. But it's going to be based on affordability. It's going to be based on more experienced borrowers. So this was a deal we closed down in Temple. Fannie Mae, a little bit lower leverage, probably 55, 60% leverage, fixed rate for 10 years, 3 years IO. So for people who are willing to put a little bit more down, Fannie and Freddie are definitely a little bit more certainty of execution. There isn't any retrades. The loan docs are pretty straightforward. Legal costs are low. And then also there's no interest rate cap. So, all right, bridge lenders. We saw this huge rundown in pricing. You were probably 3% over SOFR, and then SOFR was only 25 basis points for a lot of 2021, second half of 2021. And now we're seeing SOFR go up to about 2%. And then you're also seeing your spreads blow out to about 4.5%. So it's getting more and more difficult sort of going in to these deals, and bridge loans are, probably 6 to 6.5% starting rates. And a lot of bridge lenders are having a little bit more trouble securitizing their paper through these collateral loan obligations. And so they're increasing their spreads as well. So spreads are increasing, SOFR is going up, and then there's less lenders in the market, right? So it becomes more risky when the securitization market isn't as liquid. And so less bridge lenders end up quoting deals. And so what that happens is less bridge lenders, less competition, so spreads are going to go up. And these interest rate caps are getting pretty expensive. And, it's almost reversing now because people really don't know. I mean, we see the forward curve, but we don't know how much that's going to actually run. And so people are wanting you to actually buy interest rate caps for the full initial term of your loan. And so that can be very expensive. Third year is actually very expensive right now. Here's the loan that we closed, Point on Callaway in Hearst this week, non-recourse bridge at 70% of purchase, 100% of rehab, full term IO, and then 0.5% prepay on that one. Ended up buying a 3-year interest rate cap at a good price and able to get that loan closed this week. So here's some of the closings that we had sort of in the second quarter. Closed about 260 million across Old Capital, 30 loans, 2,500 units. As you can see, a lot of these were non-recourse bridge on the larger side. Sort of anything over 20 million was non-recourse bridge. Some of the smaller stuff, probably 10 to 15 million, where Fannie Mae or Recourse bank loans, or even getting into maybe stuff under 100 units, Freddie, SBL as well. So, so here's us. Okay, if you get through the path, past the bears, let them go by, you get to see beautiful waterfalls at the end. So in terms of guys that are able to sort of navigate this market right now, stay active as buyers, able to raise the equity, I think in a couple of years, you're going to be in a great position. You're just going to have to choose the right debt, choose the right property management company, buy the right deals, and you'll be able to make it to the top of the mountain. So once a year, we have our big event at Old Capital, September 14th and 15th. It's over at Texas Live this year. Definitely go out, get your ticket. I think a lot of deals will be coming back at that point in terms of listing and trying to finish out the year. So if you haven't got your ticket, oldcapitalconference.com. And then, Old Capital is a mortgage broker. So we go out and shop all these loans for you. Make sure you have not only the best deal up front, but then make sure you get the best deal by the time you close. And so we charge 1% of the loan amount at close. Represent you throughout the entire process. And then we help you before the transaction, after the transaction, just with market support, whether it's the podcast, whether it's YouTube, walking deals, quoting deals. So just definitely reach out if you have any questions on that. Next steps, definitely subscribe to the YouTube channel if you find this helpful. If you need help with specific loan term sheet, send me a T12 rent roll OM whisper price. We can get a loan term sheet to you. And then, in terms of just getting started, you can send me a PFS and set up time to talk from there. And then, we're always looking at people joining Old Capital. So if you're interested in that, send me an email with your resume and we can talk from there. Thanks a lot.